something just broke, and almost no one saw it. Behind closed doors, the Federal Reserve made a decision they can't walk back. And it's not just a policy change. It's a structural fracture in the foundation of the financial system, one that could spiral out of control faster than the media can report it. Let me show you what's really happening. When the Fed launched its most aggressive rate hike campaign in decades, they were trying to fight inflation. But they were also rolling the dice, because every time interest rates rise, trillions of dollars in hidden risks start to surface. Corporate debt, treasury markets, regional banks, derivatives tied to commercial real estate. It was all held together by cheap money. And now, that glue is gone. On paper, the Fed says they're managing everything. But insiders know the truth. The damage is already done. The question isn't if there's going to be a fallout. The question is how long they can keep pretending there won't be, because they've triggered something they can't control. Let's start with the banks. Most people think the banking crisis ended in 2023 after the collapse of Silicon Valley Bank and First Republic. But that was just the beginning. Behind the scenes, regional banks across America are still sitting on billions in unrealized losses, and the Fed knows it. Rising interest rates crush the value of long-term bonds. That means banks are technically insolvent. They just haven't been forced to admit it yet, but they're bleeding slowly. Commercial real estate loans are defaulting. Office buildings in major cities are emptying out, and the collateral backing many of these loans is losing value every day. Banks are stuck. They can't sell the properties and they can't refinance the debt. The Fed thought they could hike their way out of this. But now they're boxed in. If they cut rates, inflation roars back. If they keep hiking, the entire financial system cracks open. So what do? They pause rate hikes, but continue draining liquidity from the system through quantitative tightening. And that's where everything broke. Because the liquidity, the lifeblood of the system, is disappearing. Banks are hoarding cash. Credit is drying up, and the economy is suffocating from the inside out. This isn't just about interest rates anymore. It's about trust. And that trust is eroding fast. Investors are pulling out of traditional assets. Foreign central banks are reducing their exposure to U.S. treasuries. Even everyday Americans are moving their savings into hard assets, digital currencies, and private vaults. Why? Because they sense the shift? They don't know exactly what's wrong, but they can feel it. They can feel that something's off. And they're right. The Fed's tightening policy is exposing the fragility of a debt-based system. One that requires constant growth, constant borrowing, and constant money printing just to survive. But that model is reaching its limit. You can't just raise rates and pretend there won't be consequences. And the consequences are piling up. Defaults are rising. Job layoffs are accelerating. Small businesses are being squeezed out of existence by higher borrowing costs. And at the same time, the government's own debt load is spiraling out of control. As of June 2nd, 2025, the U.S. national debt has surged past $36.1 trillion. Servicing that debt now requires over $1 trillion a year just to cover the interest. That's not sustainable. Not politically. Not mathematically. And the Fed knows it. So why did they trigger this? Why did they go forward with a tightening campaign they knew could unravel the system? Because they had no choice. They needed to crush inflation, even if it meant lighting the fuse on something far more dangerous. And now that fuse is burning. There's a growing belief among economists that the Fed is no longer in control. That's being forced to respond to events rather than shaping them. It's reacting to fires instead of preventing them. And that's dangerous. Because when a central bank loses its grip on narrative control, markets panic. Capital flees. And people stop believing the official story. That's where we are right now. You won't hear this on CNBC. You won't hear this from your bank. But if you look closely, the signs are everywhere. Gold is holding near historic highs. Bitcoin, despite volatility, is outperforming traditional assets. Real estate is freezing up. And most telling of all, alternative financial systems are rising. Technologies like XRP, Stellar, Hedera, and Algorand aren't just speculative plays anymore. They're the architecture of a new financial order, one that operates in real time, with 3-second settlement, minimal fees, and no middlemen. And this is key. These networks aren't controlled by central banks. They're decentralized, programmable, and built for a world that doesn't trust the old one anymore. As the Fed loses credibility, these alternatives gain momentum. And while politicians argue over the budget ceiling and inflation targets, the real transformation is happening quietly, in code, in nodes, and on-chain. The Fed triggered something they can't stop. Not just a recession, not just a credit crunch, but a rethinking of the entire system. And as this shift accelerates, you'll have a choice to make. You can wait for the old system to collapse, or you can get ahead of what comes next. Because one day the headlines will say no one could have seen this coming. But the truth is, you did. You saw the signals, you heard the warnings, and you understood that once the Fed pulled the trigger, there was no going back. The world is changing, fast, and staying informed isn't just smart, it's survival. If you've made it this far, consider subscribing to Wealth Signal. This channel is dedicated to decoding the truth behind financial headlines, exposing hidden economic shifts, and giving you the insights no one else will. The algorithms don't want you to know this information, but you do. So stay ahead of the curve, and we'll guide you through every step of what's coming next. What the Fed underestimated was how fragile the system had already become. Years of artificially low interest rates encouraged dangerous levels of borrowing, not just by consumers, but by corporations and even the government itself. When rates began to rise, the entire economy was suddenly forced to confront a reality it wasn't prepared for. Bank balance sheets, already riddled with low-yield assets, started bleeding as bond values collapsed. Commercial real estate loans began to sour, credit card delinquencies spiked, and beneath it all, the ticking time bomb of unrealized losses continued to grow. Now the Fed faces a no-win situation. If they keep rates high, they crush liquidity and risk another wave of institutional failures. If they cut rates too fast, inflation could roar back, slamming the public with even more pain. But the worst part, the tools they once relied on no longer work like they used to. Quantitative easing, stimulus packages, emergency lending, all of it now risks triggering the very instability they're trying to avoid. The public is growing skeptical. Foreign investors are growing cautious, and the markets are more volatile than ever. This is the moment when confidence becomes the most dangerous illusion of all. The truth is, the Fed can't print trust, and once that's gone, the unraveling accelerates. If you're still watching, it's because you're one of the few people who actually wants to understand what's really going on. So here's what to watch for next. Central bank interventions that look like routine measures, but are actually desperation moves. Quiet liquidity injections. Emergency meetings that aren't covered on the news. Rate policy language that sounds cautious but signals panic behind the scenes. This isn't just about economics anymore. It's about control, credibility, and the survival of a system that's running out of ways to patch itself together. And here's the part almost no one is prepared for. Out of this chaos, new financial architectures are emerging. Technologies like XRP, XLM, and HBAR, ones designed for instantaneous, trustless settlement, are no longer fringe concepts. They're being tested by real institutions, quietly, steadily, and without public attention. What comes next isn't just a reboot. It's a replacement. And once that switch is flipped, there's no going back. If you made it this far, consider subscribing to Wealth Signal. We're breaking down the real events behind the headlines and exposing what most people never see coming. Stay informed, stay sharp, and stay ahead of the curve.